On December 1, 2001, 40 million Argentinians went to sleep believing their money was safe in the bank, and when they woke up the next morning, they discovered the government had frozen every account in the country, limiting withdrawals to $250 per week, which meant that the carpenter who had saved $30,000 over 20 years to buy a house could now access only 1% of his wealth per month, and the retiree living on a pension of $1,000 suddenly had access to only 1/4 of what she needed to survive, and the business owner with $50,000 in the bank to make payroll couldn't pay his employees. And this wasn't a temporary emergency measure that lasted a few days. This was a policy called the Corralito, which translates to little fence or playpen, a name that makes it sound almost cute, when what it really meant was that the government had built a cage around your life savings, and you were locked inside, watching your wealth evaporate, while politicians promised it was for your own good. This is the story of how a prosperous nation destroyed itself in less than a decade through a combination of currency manipulation, unsustainable debt, and the kind of political cowardice that always chooses short-term survival over long-term stability. But more importantly, this is a warning about what happens when a government runs out of other people's money to spend and turns to the one source it can still control, which is the private savings of its own citizens. And if you think this is ancient history that couldn't happen in a modern developed democracy, then you haven't been paying attention to what central banks around the world have been quietly planning for the last 15 years in the name of financial stability and emergency preparedness. Argentina, in the 1990s, was the poster child for successful economic reform, a country that had suffered hyperinflation in the 80s that destroyed the middle class and made planning impossible. But in 1991, the government implemented something called the convertibility plan, which fixed the Argentine peso to the US dollar at a 1-to-1 rate and required that every peso in circulation be backed by an equivalent dollar in reserves. And this wasn't just a policy, it was written into law. The government legally bound itself to maintain this peg, and the effect was immediate and dramatic. Inflation dropped from over 1,000% to single digits, foreign investment poured in, GDP grew at 5% per year, and for almost a decade, Argentina looked like proof that market reforms and currency stability could transform an economy. But there was a problem hiding in plain sight, which was that maintaining a currency peg requires enormous discipline. You can't print money to fund government spending because every peso must be backed by a dollar you actually own, and the Argentine government had never shown that kind of discipline. The political culture was built on patronage and public employment and subsidies to powerful interests, and these habits don't disappear just because you pass a law saying they should. So instead of reducing spending to match the constraints of the currency board, the government did what governments always do when they can't print money, which is borrow it. Throughout the 90s, Argentina's government debt grew from $30 billion to $140 billion, and this might have been manageable if the economy had continued growing and tax revenue had kept pace. But by 1998, several things happened simultaneously that exposed how fragile the whole system was. First, the Asian financial crisis reduced demand for Argentine exports. Then Brazil, Argentina's largest trading partner, devalued its currency, making Argentine goods suddenly expensive by comparison. And at the same time, the dollar was strengthening globally, which meant the peso was strengthening because it was pegged to the dollar, making Argentine products even less competitive internationally. The arithmetic was brutal. Argentina was stuck with a strong currency it couldn't devalue, declining exports, rising unemployment, and a massive debt burden in dollars that was getting more expensive to service as the economy shrank. And the rational response would have been to either break the currency peg and let the peso find its natural value, or implement severe austerity to balance the budget. But the currency peg was politically sacred because everyone remembered the hyperinflation of the 80s, and austerity was politically impossible because no politician wanted to be the one to cut spending and lose the next election. So instead, the government chose the third option, which was to pretend everything was fine while borrowing more money to cover the gap between spending and revenue. And remarkably, the international financial community went along with this charade. The IMF extended multiple loans totaling $22 billion based on reform promises that were never implemented. Foreign banks bought Argentine bonds at premium yields, and everyone pretended that a country with declining revenue and rising debt could somehow grow its way out of the problem, which is the same fantasy that's been used to justify unsustainable borrowing in every financial crisis throughout history. By 2000, the situation was desperate, the economy was contracting, unemployment had reached 15%, tax revenue was falling, and the government needed to borrow just to make interest payments on existing debt, which is the definition of a debt spiral. And what makes this interesting from a psychological perspective is that everyone involved knew it was unsustainable. The government knew, the IMF knew, the banks knew, but each had reasons to keep the game going just a little longer. The government wanted to survive until the next election. The IMF wanted to avoid admitting its previous loans had been a mistake, and the banks wanted to collect as much in interest payments as possible before the inevitable default. The trigger came in November 2001, when depositors started withdrawing money from banks at an accelerating rate, not because of any specific news, but because the logic of the situation had finally become undeniable. If the government couldn't pay its debts, it would have to print money, and if it printed money, the currency peg would break, and if the currency peg broke, the peso would collapse, and if the peso collapsed, then peso deposits would lose value. So the rational move was to withdraw pesos and convert them to dollars. Except that when everyone tries to do this simultaneously, the thing they're afraid of happens immediately rather than eventually. In the last 2 weeks of November, over $3 billion left the banking system, and the government had 3 choices: let the run continue until the banks collapsed and the currency peg broke, provide unlimited dollar liquidity to prevent the run, which would drain reserves and force a currency crisis anyway, or stop the withdrawals by force. And on December 1, 2001, Economy Minister Domingo Cavallo announced the Corralito, freezing bank accounts and limiting cash withdrawals to $250 per week. If you're watching this and feeling a cold recognition in your stomach, like maybe you should check your account balance or call your bank just to make sure your money is still accessible, then you're starting to understand what it felt like to live through this. And maybe you should subscribe to this channel right now, because understanding how these crises unfold is the only way to protect yourself when it happens again. And it will happen again because the mechanics that destroyed Argentina haven't changed, only the countries involved. So click that subscribe button and turn on notifications, because what happens next in this story is going to show you exactly what a government does when it runs out of options and has to choose between its own survival and your property rights. The Corralito lasted for almost 2 years, but the real damage happened in the first few months, because once you tell people they can't access their money, they stop thinking of it as money at all. It becomes a number on a screen that has no relationship to the real economy, and the economy requires actual cash to function. So immediately a parallel economy emerged, where people traded goods and services directly or used dollars that had been withdrawn before the freeze or found under mattresses, and the official economy just stopped. Businesses couldn't operate because they couldn't pay suppliers or employees. Employees couldn't pay rent or buy food beyond what they could access with their weekly withdrawal limit. Unemployment jumped to over 20%. Poverty doubled, and the streets of Buenos Aires, which had been cosmopolitan and prosperous just months earlier, filled with people banging pots and pans in protest every night, a sound called cacerolazo that became the soundtrack of the collapse. The government promised the freeze was temporary, that it was necessary to prevent a complete banking collapse, that savings would be protected, but of course savings weren't protected because the government couldn't simultaneously freeze accounts and pay its debts. So in January 2002, they did what everyone had known they would eventually do, which was abandon the currency peg, and overnight the peso that had been worth $1 was now worth 3 pesos per dollar, and within a year it would take 4 pesos to buy $1. But here's where it gets truly criminal, because when the devaluation happened, the government decreed that bank deposits denominated in dollars would be converted to pesos at the 1-to-1 rate and then unfrozen, which meant that if you had $10,000 in the bank, you now had 10,000 pesos, which at the new exchange rate was worth only $3,300. The government had just confiscated 67% of dollar deposits through a combination of forced currency conversion and devaluation, a process called pacification that was sold as necessary to save the banking system, but was really a way to partially default on domestic debt while protecting foreign bondholders. The depositors sued, thousands of cases flooded the courts, and eventually many got rulings in their favor, but by then the money was gone, spent or inflated away, and the lesson was clear. When a government gets desperate enough, it will take your savings. It will do it through legal mechanisms that sound technical and necessary. It will tell you it's temporary and for your own good. And when it's over, you'll discover that the wealth you spent years accumulating has vanished into the same void that swallowed the government's fiscal responsibility. What would you have done differently if you had known this was coming? Would you have withdrawn your money in October when the first signs appeared, moved it offshore, bought property or gold? Or would you have trusted the government's promises like most people did because pulling your money felt paranoid, and surely they wouldn't actually steal from their own citizens? And that's the trap. The moment you recognize the danger, it's often too late to act because capital controls get imposed overnight, and acting before you're sure makes you look crazy until it doesn't. The total cost of the crisis is hard to calculate because the damage happened at multiple levels. The direct theft through pacification was estimated at $40 billion in wealth transferred from savers to the government and banks, but the broader economic collapse cost far more. GDP contracted by 28% peak to trough, making it one of the worst peacetime economic collapses in modern history. Millions fell into poverty. The middle class that had been the foundation of Argentine society largely disappeared, and the country defaulted on $93 billion in foreign debt, the largest sovereign default ever recorded at that time. But what's most important for understanding why this matters today is not the statistics, but the mechanism. Because Argentina showed that in a crisis, a democratic government will choose to confiscate private wealth rather than accept political defeat. And they'll do it through legal channels that are technically constitutional. They'll frame it as an emergency measure to prevent something worse. And they'll rely on the fact that most people won't understand what's happening until it's too late to protect themselves. The parallels to today's financial system are not subtle. Developed countries are carrying debt levels that are only sustainable if interest rates stay low forever. Central banks have created trillions in new currency to fund government spending, and increasingly there's talk of digital currencies that would give governments perfect visibility and control over every transaction, every account, every financial decision you make. And if you don't think that control would be used in a crisis, then you haven't been studying history. What happened in Argentina wasn't unique. Similar bank freezes and forced currency conversions have happened in Cyprus in 2013, where accounts over €100,000 were seized to recapitalize banks, in Greece, where capital controls limited withdrawals for years, in Ukraine, in Venezuela, in Lebanon. The pattern is always the same. Government debt becomes unsustainable. Depositors start withdrawing money. Government imposes controls. Wealth gets confiscated through some combination of inflation, conversion, or direct seizure. And by the time the dust settles, the people who trusted the system have lost everything, while the people who moved their wealth early were accused of being unpatriotic or criminal. The question isn't whether this pattern will repeat, but where and when. And the answer is probably sooner and closer than you think, because the debt levels in developed countries today are higher than Argentina's were in 2001. The unfunded liabilities are larger, the political will to make hard choices is weaker, and the tools for controlling and confiscating private wealth are more sophisticated than ever before thanks to digital banking and surveillance technology. You probably think your deposits are insured, that the government guarantees them up to some amount, and that's technically true. But what you need to understand is that deposit insurance only works in normal times. When a small number of banks fail, it's not designed to handle a systemic crisis where the entire banking system is insolvent, and in that scenario, the government has to choose between printing money to cover deposits, which destroys the currency, or imposing controls, which destroys trust. And historically, governments choose the option that destroys trust because currency collapse happens fast and is politically catastrophic, whereas the slow confiscation of wealth through inflation and capital controls can be stretched out over years and blamed on external forces. The lesson from Argentina isn't that you should panic and withdraw all your money tomorrow. That's probably counterproductive and might trigger exactly what you're trying to avoid. The lesson is that you need to understand the warning signs, the trajectory of government debt, the stability of your currency, the health of your banking system, and you need to have a plan for what you'll do if those signs start flashing red. Not a plan you'll think about when things get bad, but a plan you've already thought through and are prepared to execute, because the window between recognizing danger and losing the ability to act is measured in days, not months. The depositors in Buenos Aires learned this lesson the hard way. They woke up one morning and discovered the rules had changed overnight, that the government they had trusted to protect their property had declared their property to be a resource it could tap in an emergency, and by the time they understood what had happened, the banks were closed, the borders were controlled, and their life savings were trapped behind a legal fence they couldn't climb. 20 years later, Argentina still hasn't fully recovered. The economy cycles between crisis and fragile stability. Trust in institutions remains low, and anyone who lived through 2001 keeps some wealth outside the banking system because they understand that property rights only exist until the government decides they don't. And this cultural knowledge, this collective memory of betrayal, is perhaps the most lasting damage, because an economy can't function efficiently when nobody trusts the system, when every transaction is viewed with suspicion, when every promise from authority is assumed to be a lie. You're probably wondering what you can do with this information, what concrete steps make sense, given that you can't live outside the financial system entirely. And the answer is diversification, in a way that most people don't practice. Not just diversification across stocks and bonds, but across jurisdictions, currencies, and asset classes that can't be seized by decree, which might mean holding some wealth outside your home country, owning assets that retain value in a currency crisis, having accounts the government doesn't know about or can't access easily, and accepting that the cost of this protection is worth it, even if the crisis never comes. Because the cost of not having it when the crisis does come is total. The government officials who implemented the Corralito justified it as necessary to prevent complete economic collapse. And maybe they were right in the narrow sense that letting the bank run continue would have been even worse. But this argument misses the point entirely, because the crisis didn't start when depositors tried to withdraw their money. The crisis started years earlier when the government made promises it couldn't keep, spent money it didn't have, borrowed money it couldn't repay. And when those decisions finally produced their inevitable result, the government chose to rob the people who had trusted it rather than accept the political consequences of its own failures. This is the real story of Argentina in 2001, not a tale of economic mismanagement that could have been avoided with better technical policies, but a demonstration of what governments do when they run out of options, which is whatever they have to do to survive another day. And if that means your savings have to be sacrificed for the greater good, well, that's just the cost of living in society, and you should have known better than to trust them anyway, except that you did trust them, because that's what law-abiding citizens do. They follow the rules and expect the rules to protect them, and discovering that the rules can be changed retroactively to transfer wealth from you to the state is the kind of lesson you only learn once. If this has made you uncomfortable, if you're looking at your bank balance differently than you were 20 minutes ago, if you're starting to wonder whether the promises your government makes about deposit insurance and financial stability are any more reliable than the promises the Argentine government made in 2001, then you need to watch the next episode in this series, because we're going to show you exactly what central banks have been planning since 2008 to make the next crisis more controlled, more efficient, and far more invasive than anything Argentina experienced. Subscribe now and turn on notifications, because this is information they definitely don't want you thinking too carefully about, and that's exactly why you need to understand it.